Thanks everybody for logging in today. I'm going to give a quick intro to Seedrs first, so everybody's aware about what we do. And if you're interested in our services, you can contact us directly. And then after, I'll give the word to the team at Zanda. So normally my colleague Ross, who's partnership manager here at Seedrs, would have given a short intro to Seedrs, but as he's ill today, he's sending his apologies. So Seedrs, so what do we do? We're an online platform for investing equity in startups and growth companies. So we allow investors to invest as little or as much as they like in businesses they believe in and share in their successes. So we allow any ambitious businesses in all kind of sectors to raise capital and build a community through an efficient online process. So you can essentially raise money, you can build a customer base, you can do a marketing campaign all alongside your fundraising campaign. In the meantime, if any founders would like to discuss fundraising with us, feel free to send Ross an email on ross.kelly@seedrs.com. But we'll be sending his contact details in a follow-up email as well. And he'll be happy to set up a chat with you. So for today, it's our second session of a series of 4 with Zanda. Zanda is an exec search platform who focus on the startup and scale-up space. But I think Andrew will be happy to introduce you himself. So without further ado, over to you, Andrew.
Thanks, Laura. I appreciate that. So yeah, welcome everyone, and thank you for joining us today. And if you joined us on the first session we did as well, it's great to kind of have you back for the second session. So who is Zanda? So I'm one of the founders of Zanda, and Zanda essentially supports startups and scale-ups with their finance function. So supporting startups, typically seed, Series A, Series B, with their number 1 in finance or their finance leader, whether that's a portfolio CFO, up-and-coming finance director, head of finance, or a full-blown strategic experience CFO. And then we support scale-ups and later stage startups with the team below the CFO as they look to build up that function. So we operate in London and in New York, but we do cover kind of major cities and hubs in Europe and outside of London and New York in the US and the UK. Predominantly we support VCs or founders for the seed, Series A, Series B piece, and then Series B, Series A onwards as they look to scale. We support the CFO with the function below. Today, the first session was all around assessing your startup to ascertain the right level of finance leader. So what are the 3 or 4 key considerations to take into account when you're assessing your startup to decide on whether you need a full-blown CFO, a portfolio CFO, or a hands-on controller, or an up-and-coming ambitious individual? Today we're talking about where you take it from there. So hopefully there's a number of finance leaders on this session, so some finance directors or head of finance or CFOs, but maybe there's still some founders on here that are doing the finance function themselves currently and come from a finance background, whether that be investment banking or private equity, and are looking how to establish a forward-looking finance function. So that's what we're going to cover today. Really keen to have someone who's experienced in this space give their thoughts and their experience. So that's why we've invited Jason on today. And Jason, if you don't mind just giving a quick overview of your background, that would be really helpful.
Sure. So Jason Kirkbride, I am the CFO of Teqball Group. The group consists of sports and media, technology, manufacturing, and consumer sort of interests. Our main product is a curved table tennis table, which a game of football is played effectively. You may have seen it on David Beckham's Instagram profile, or maybe even your local football club's football ground. Most Premier Leagues have the table. We have a sport on the side of that as well, which the fastest growing sport in the world currently. So very entrepreneurial, very sort of taking it from early stage to development. When I joined, we were 9 employees. We're now 200 plus globally. We have 9 entities around the world, including UK, Ireland, Luxembourg, Hungary, US, China, and Switzerland. So my main remit when I joined was to raise Series B, a large Series B round, which we did successfully, and then put the processes in place to help a company develop, including an ERP system, policies and procedures, and build the team from one person to the 12 which we have currently. So Teqball's very entrepreneurial, very fast-paced. It's, I think you can see that from the fact we've moved into esports during COVID, and our social media strategy is a little bit groundbreaking for the world of sport, at least. On the back of the CFO role, I then manage a small advisory company in London, looking at CFO portfolios and transaction advisory services for sort of early stage businesses as well. I took the traditional route, qualifying as a chartered accountant and then qualifying as a corporate finance practitioner, spending 8 years in corporate finance in leading firms in London and New York, advising on probably 50 plus transactions in a number of sectors, including technology, consumer, healthcare, manufacturing, and media. And those transactions range from fundraisings for seed, Series A, Series B, Series C, company exits, and mergers.
Very good overview. Thanks, Jason. And how good are you at Teqball?
Not very. I'd probably be fired if they could actually see my true ability, unfortunately.
It looks fun. I'd like to give it a go at some stage. So if we could just launch some of the polls now, Laura, just very keen to kind of get an understanding of the audience and then tailoring some of the content in the presentation to those individuals. So if you don't mind kind of responding to the poll as soon as you can on those questions, that would be greatly appreciated. So what we're trying to get here is the level of the number one in finance or your personal role. So as I alluded to, there may be some founders or CEOs that are looking after finance currently. You might be an outsourced finance professional, or indeed you might have outsourced finance and you're the founder. So hopefully that's reasonably self-explanatory. So if you could fill in your role or what the number one in role in your finance function is. Look. Okay, so a lot of founders looking after finance as well, which is actually quite interesting. And actually then a lot of FDs and CFOs and not too many on the outsourced piece. So that's quite useful, Jason, to know, isn't it, in terms of we now know that there's a lot of founders there that are looking after finance as well. So if we go to poll 2.
Just quickly, there is a question of Charles who asked whether Jason could speak a bit closer to the microphone.
Sure.
Yeah, great.
So this is, obviously this is specifically more organization focused. So I'd say if you're a founder and you're looking after finance, probably put 0 unless you see yourself doing that kind of long term. It may be that you're a co-founder and CFO, and there's obviously co-founder COO, co-founder CEO. But answer this as best you can, but I'd expect maybe quite a lot of these responses would be 0 perhaps. Yeah, so 0, 1 to 4. So kind of quite similar to where Jason was when he first joined Teqball, and the first kind of year of your Teqball journey, would you say, almost?
Yeah. It was the 2 of us for the first year.
And then we got to the final poll. So it's just, again, another company question around your stage. So pre-seed or seed or Series A, B, and then onwards, whether it's a C plus or PE backed. Again, based on the initial response, I'd say most would be in this pre-seed, seed, potentially the Series A, B box. But if you could fill that in, that would be great. Yeah, perfect. So nearly, 70% pre-seed, seed, and then about 20% VC backed A, B, C. So that's really useful. Thank you, Laura. So thank you for helping with that. Now I just need to get the slide in the right place. Right, so essentially what we're going to do today is cover all of these topics. So the finance function blueprint and how we see that, and how that's evolved, the specifics around the structure and other areas, and the technologies that you can consider and opt for, and finance structures, and then external advisors and key milestones that you may be facing. So the finance function blueprint, the role of the finance function has evolved a great deal. So if we look back 30, 40 years, the finance function was very much focused and heavily focused on Guardian, to making sure that the accounting processes, the tax, the audit process was successful. It was all about passing the audit and all about making sure that the numbers were accurate and timely. If we fast forward to, or if we come to the present day, it's a much more balanced approach where there's still a lot of concern and time spent on the Guardian piece, but there's a much broader range around the strategy. We're using the data and the analytics at a much greater degree to define the strategy of the business. And finance has got a great habit, because of the academic, professional type background that finance functions possess in terms of personnel, to take on more or be given more by investors or by founders or CEOs. So that's the change in the ops piece. We've seen, heavy areas of ops and HR and data to feed into a finance role now. And the change piece is the only consistent at the moment is change, and finance is playing a leading role in that. Where do we see the finance function going in 30 years' time? We see that the Guardian and ops piece is an element that can be outsourced by technology or external support, leaving more time on strategy and change. Change is essential because that you have to be nimble to be able to deal with that and be ahead of the curve, and obviously that links to the kind of the strategy piece. So that's essentially the finance function has evolved from a backward looking transactional finance function to a more balanced finance function now, to in the future a more data driven, strategically driven finance function where technical reporting and transactional elements can be outsourced or be made more efficient by technology. And it's essential for us to keep ahead of that curve as an organization and making sure we're embracing those changes. So that's the finance function. Now, the finance leader, the CFO, the FD, the controller who's number one in finance, essentially their role is also very broad. It obviously changes, but this slide is an example of the CFO toolkit we use for the Future CFO program that we partner on with Grow CFO. So the Future CFO program is a kind of interactive online and cohort learning process for up and coming CFOs. And it enables you to mix and learn with a new network within the cohort group, do the up to 200, 300 hours of online lessons, and then basically learn from CFOs in CFO Q&A sessions. But we also have CFO sessions on each of these 9 areas. And these are the areas that we see are the skills and experiences that a finance leader or CFO or FD needs to have. And it covers all of these areas: governance and control, ops driver, financial planning analysis, which we consider as the foundations to the finance function, which probably do cover elements from the previous slide across Guardian and ops and change. Then the strategic business partnering and the catalyst for change, fundraising and M&A, and how that's more strategic and forward looking and business partnering. And then the final piece of the jigsaw is being an impactful CFO, which is focused on more of the softer skills and how you approach those arguments. The CFO role, if we think about when I was recruiting these CFO roles in growth businesses or scale-ups 5 years ago, it was very popular in a scale-up or a startup that the CFO would do a CFO/COO role, where it was very broad. They had HR feeding in, they had ops and change feeding in, and they were responsible with the full 360 essentially. And they have the benefit of having all of the data feeds into the business that a CEO will see. So you've got that privileged view of the 360, all the data flows coming in and out. So where we see the role going now already and also in the future is that business intelligence and data analytics will also feed through to the CFO in a number of roles. And that piece will enable the business to kind of extract the data correctly, but also utilize that data to steer the strategic decisions that the business makes. So this is a big thing. I think the tech automation piece does two things. It enables to automate and outsource some of the technical and the operational and transactional accounting, creating more time and lowering the cost to enable the team to spend more time on the FP&A and non-financial kind of the planning analysis KPIs. But also you've got the accurate data to then kind of present the analysis. So that's what we see with regard to kind of the evolving number one role. It's very interesting actually, because when Jason and I were talking about this, and we've obviously been speaking for quite a while, we talked about the evolution of the finance function and where it was and where it's going. We talked about the CFO toolkit and how we see the skills and experiences required in a forward-looking CFO. And then I asked Jason to kind of give his views on what he considers finance are, and we basically came up with pretty much the same presentation slide. So I'll let you talk through this, Jason.
Yeah, so this is a presentation I gave to my company when I'm trying to explain to an entrepreneurial business what is finance. I think the traditional approach was the steward or the guardian in the previous example. So this diagram is really to explain to the entrepreneurs and the people behind our business, Teqball, what a CFO and a finance function should be aiming to achieve, which was the stewards, a catalyst, a strategist, and an operator. And then you have the different elements of those, which is control, execution, performance, and efficiency. So, to your example, Andrew, I mean, steward is really protecting the company's assets, ensuring financial regulation and compliance, and really raising any issues to the board and the investors. That's the guardian piece. You have a catalyst, which is probably a bit more forward-looking, which the finance function is looking to increase efficiency or drive initiatives for the better of the company. The operator, I would put the FP&A in there, the treasury, tax structuring, all that sort of stuff in the operations piece. And then I think the real value add piece is the strategist, which really comes from the top level, financial leadership, being able to align the business's strategy with the finance strategy.
And in terms of this slide, obviously you came up with this. Was this a few years into your role? Because it didn't look like this to begin with. I assume you inherited a seven-person.
It did, to be honest. When I met the company and the sort of the investor behind it, this was the presentation I gave. So this probably gave this within 6 months of joining. My original role was really just to join and raise Series B. It wasn't to join as a CFO. I inherited the role just because, as often happens, a business grows very fast and doesn't really pick up, the steward piece effectively. So to be able to pull together a business plan and a financial model, I had to fix the historics, getting the finances in place. So this was really when the CFO role became available, or they asked me about it. This was my positioning of how I see the CFO role in the finance team, playing a part in the wider business.
And when you do consulting assignments under your advisory firm, whether that's a Series A raise or an IPO process or whatever, do you instantaneously go to the steward guardian piece initially first?
I think you have to be able to rely on the information you're given. So it's definitely, a check. I mean, it's always looking at the qualifications of the person in charge. If they're a bookkeeper, that's great, but are they going to be able to, look at R&D tax credits, for example, or have they looked at R&D tax credits? Are they adding value, or are they literally booking invoices? If they're just booking invoices, then I probably need to look into it from a steward and operation perspective a bit more in depth. If they have great financial data and a great process, then it's much more on the higher level that I can focus. So it really depends, but it definitely needs, you need to spend a bit of time understanding the business model and what's being captured in the processes behind the finances.
It's interesting, isn't it? Because as a CFO, we talk about this in the Future CFO cohort program, that obviously as you come into your role, you will have strengths maybe from an FP&A perspective, you may come from an investment banking perspective, you may be an auditor. But even if you're ACA audit trained, by the time you're doing the CFO role, it's probably quite a while since you've been doing your articles or been doing audits. And the aim is really for a CFO to be adding value from a strategic, influencing the strategy and the commercial perspective. But audit does still sit under you, even if you've got a group accountant or a financial accountant or group reporting manager. You still need to have that responsibility because you're signing it off. And that's a big challenge. You've got to obviously also know how to lead different teams, even though you've not done that for a while.
Yeah, I think the whole challenge with being a CFO is being able to sort of you understand enough of each aspect, whether FP&A, tax, VAT, whatever aspect. You're able to, you have the training that you can actually give yourself an understanding of that aspect, whether it be international VAT, international tax structure, and ask the right questions relevant to the business you're dealing with. Now that's the skill set, I think.
And you made a really good point when we were talking before this, maybe a few months ago, and you were talking around, outsourced finance function. That if it's an outsourced accountant or a bookkeeper of some sort, they'll be very good at the kind of past accounting related elements. But just sometimes spending time with an experienced CFO on something like tax and R&D tax credits, there's such a ad hoc wins that maybe you wouldn't consider.
Yeah, definitely. I mean, it's like building a house with a builder. You know designs from an architect, but you employ a builder to build a house. You're not going to get a very well designed house if you haven't got the design and the engineering background behind that. They're going to put some bricks in place, but are you going to want to live there?
Yeah, that's really interesting.
I think so the expertise of a CFO or somebody, finance manager, with the relevant skill set, definitely to put you on the right track, ask the right questions around R&D tax credits, which are a huge benefit in the UK, to be honest, which a lot of people don't make use of.
Yeah, no, I agree. So just to dip into the specifics then, and this is kind of the specifics around building an impactful finance function, not necessarily from scratch. If you inherit it, what you look at, or maybe if you are building it from scratch, just talk us through kind of your considerations on this, if that's okay.
Yeah, sure. So, the structure, the policies and procedures, I think is, a key consideration right from the offset. It's whether, what sort of ERP system you're choosing, what your objectives are, and then you can choose the ERP system to go with that. So that's really the first stage. It's simple, and for that ERP system, you should be looking at something which is simple and effective. You put policies and procedures in place, clear division of responsibilities, and the team structure aids efficiency. So you don't want numerous checks on the same invoice or process, because that's not going to be efficient at all, really. And one of my focuses at Teqball has been focusing on automation of sort of what I would call non-value added areas, such as AP and AR. It's a process. It's quite easy to automate them. Even the most basic systems now have an element of automation. So you can save a couple of employees' time by investing a little bit of money and time just getting those automations set up. And then management information, that's obviously more strategic. You need the information to drive the business. It should be the right information. Benchmarking performance, being cost, productivity, efficiency, etc. And the use of smart KPIs, so specific, measurable, achievable, relevant, and timely KPIs. I think a lot of businesses get lost in producing numerous KPIs and then losing track of what's what, really. I think having less than 5 KPIs by departments is always beneficial. And the management information and dashboards, as much as possible, should, I always like them real time. So I use Power BI. We plugged Power BI back into the back end of our system. So I have real-time information 8 times a day. And I think that ability to have that real-time information, translate that into a strategy is very, very important. And then we have forward-looking. So finance, the value add is being able to look forward and sort of raise issues, whether it's cash flow or anything like that. That's really where you're going to reduce the risk and add some value. So the ability to analyze and react to the financial results quickly is key. The annual budgeting and frequent updates, if it's a rolling forecast, that's key to cash flow management. without cash flow management, you're running a very dangerous show. And then constant communication with the leadership team, really. Without that, you can't, especially in startup phase where you have no sort of basis of results, you can't predict what's going to happen the next month. So you need to be talking to sales, to marketing. If you have a push on, what you can expect from sales. If you're selling a product, then the logistics and the warehouse is going to be an impact there. So maybe you need to upstaff for shipments. So the communication is very, very important. And then from a strategic perspective, it's really having the ability to apply the risk appetite of the business, understanding the risk appetite of the business, and then applying the financial strategy to balance the risk and returns. You need risk in a business. Without risk, there's no returns. It's being able to translate that into what's acceptable from a financial perspective. And that strategic piece also covers M&A opportunities, which can create value with the right possibility. And then translating that vision into the positioning of the business for the future. So you have to be able to take what the vision is for the business and translate it into a financial strategy, position the business ready for exit if that's a 3 to 5 year plan or longer.
And you've obviously you've talked about KPI dashboards there, and I assume you also have kind of monthly or quarterly board packs or board reporting. How do you, in your ideal situation, and you may have that now, you may not have that now, because I know you've got, very entrepreneurial kind of founders, and it's very, it changes very quickly. But in an ideal situation, your current situation, how would you want finance and a finance leader to produce to be interacting with the board on KPI dashboards and board packs? What are you doing at the moment, and what works and doesn't?
Yeah, so we put Power BI in, so everybody has full visibility in our business. We think that works better. I think quarterly board packs is they're great, that they're normally very historic. It takes time to produce. We're driven by the sales of our tables online, for example, so very consumer e-com focused. So we want to see whether it's Google Analytics or whether it's Power BI, we want to see any marketing activity, what impact that's had on sales in real time. And then, we're tracking other aspects as to when a sale comes in, how quickly we're getting that sale out the door. So that's why we use Power BI, because we can overlay numerous pieces of data, not just which is captured on the e-com platform. So we're using our whole ERP to push data in, which tells us that, okay, we're taking 10 days to ship a table, just get it out of the factory, which is way too long. We need to get that down to 2 days. It's all about consumer experience from our perspective. So the management board have access to Power BI. They can raise questions within Power BI. I can answer them at any point, and then we have a catch-up monthly. The CEO, obviously much more frequently, but with the board, it tends to be on a monthly basis.
Do you ever have challenges with non-data finance focused senior management with understanding or actually spending time looking at it every day?
Yes, I think having the time for the senior team to spend looking at the dashboard, for them it's not always valuable. They don't often, at the beginning, they don't see the value. I think once they've understood how the dashboard works, we've implemented, for example, we've made it very visual. So we've taken the numbers away from it. So it's not just numbers. We're looking at sort of, a global map with heat spots of where we're selling tables, and you can, drive that by the different SKUs, the different sales guys. So we can instantly see that we've sold 400 tables to Italy, and they're all down the West Coast. Something like that. So it's very visual. They can focus on that. I think our business model is a little bit unusual in the sense that we have a consumer product, but we also have a sport. So, we've created our own market to sell a product into our market. So we have two aspects. And if we can visualize where we're selling tables, we know where the sports clubs are likely to pop up, which is helpful for the sports side and the sports federation side and things like that.
Well, it's a really good overview. And if we obviously dipped into Power BI there, but in terms of, I guess, formerly traditionally an ERP system or a finance system. What do you weigh up as a finance leader trying to make the right decision? Because it was what was your first point on building an impactful finance function, is choosing the right system. Is it really that important?
Yes, yeah, it is, to be honest. And that was, when I inherited this role, or took this role, it was a case of having, I think at the time, 5 or 6 different entities, all using different systems, all different chart accounts. We had a sports federation in Switzerland, we had a manufacturing entity in Hungary, we had sales and marketing in Ireland, all, sort of not working independently, but definitely not working together. So I think, the first consideration for choosing a system is really, what the objective is, business model, what type of business model this is, what the objective is, and the costs. They vary in pricing. From the Xero, we'll talk about it in a minute, but the Xero is quite cheap. You have add-ons, but then you have your SAP, which is sort of gold standard. So the cost is a big driver, depending on what stage of business you are. And then the scalability of those systems. So, if you're looking at one territory just in the UK, then, you're probably going to go more towards Xero or Sage. If you're looking on an international aspect, you may want to go more to something Microsoft Business Central, SAP or Oracle. There are certain limitations if you open subsidiaries in certain countries. For example, in Hungary, we could not utilize Xero at the time, because Hungary requires the accounting system to be linked to the government's tax portal, so that they have real-time analysis. So it's really being aware of where you want to go long term. And one sort of thing I would always consider is actually accessibility of system expertise. We actually use Microsoft Dynamics Navision, and there's not many people out there that actually know the system. So that's a key consideration. When you're looking at Xero or QuickBooks or Sage, there's lots of people out there. The Microsoft program, less. And it's very important to understand each system. And then the last point I'd probably consider is the compatibility of any add-ons. So, we talked about AI earlier and automation. Most systems have that, but it depends on what level you want to get to and how tailored you need to make it. So, for example, Xero has it, but are they able to overlay numerous sort of flows of a PO process approval? No, they can do a very basic PO approval, but they can't do multi-level approvals without further additions and add-ons. And then you have your expense management and document management, which should definitely form part of that consideration.
So obviously on this call, Jason, there's a lot of founders that are also doing the finance leader role. Does that point to a certain system, and actually how much of the functionality can they do themselves?
I think depending on the business model is always going to be, if it's manufacturing, if it's sort of like SaaS-based tech, it's always going to drive what your needs are now and what they are in the future. But from a startup perspective, I think I quite like Xero. I think it's a very basic system. The cost is very low, but you have the ability to add to it, and at which stage it'll probably get more complex and obviously more expensive. But Xero as a base is fantastic. I think there's a lot of people out there in the UK and Ireland which can use Xero, and to be honest, you can probably use it without any finance experience or very limited. They have the automations built in. They have once you sign up, you have a pre-populated email address you can send invoices to. They can be automatically imported, and then you effectively change and tweak any aspect. So it's taking the manual labor out of it as much as possible, and that's in the basic system. So without knowledge, I would probably go for a more basic system, which would be Xero.
And if you're a founder who's also doing the CFO role, you're the number one, or you're a number one in finance, feeding into a CEO founder, and you use Xero, and then things, I guess, the product market fit works, and you go from being a steady business to a hyper growth business looking to expand. How long and how far ahead and how long would it take you to transition from a Xero to a more appropriate system?
I think depending on the complexity again, like when we look at putting a full sort of complex Microsoft product in place, you're looking at 9 to 12 months, to be honest. But that includes, very complex process flows for purchase order approval, barcoding, very complex process of intercompany transactions. We effectively ship direct from Hungary, but via 2 to 3 different other entities globally. So we need to automate the flow of invoicing. Whilst the product goes direct, there may be 3 invoices intercompany behind that. So for our level, we're looking at 9 to 12 months. I think if it's a relatively vanilla business, it shouldn't take long at all. It's all to do with setup, and setup's key to getting building for the future. If you have the foundations wrong in the system, you're going to have some big issues later down the line. So it's better to take more time, have a professional help you implement it for your long-term objectives. Take longer, but it's a good base for future growth and stability.
One of the things that we talked about in the first session a few weeks ago is the considerations that you need to think about from a founder of a startup when deciding level of finance to bring on board. Is one of the key considerations is realistic growth trajectory, and realistic is it's been tested by someone, and that it's obviously entrepreneurs are very passionate and believe in their business and their product more than anyone, and therefore they're always going to be super positive about their growth trajectory. But that consideration, if it's a realistic growth trajectory that is very, very strong, is a key consideration with the level of finance hire. Is that also a key consideration with the finance system that you go for in the first instance? If you've got a lot of confidence about the growth and the product and the fundraising, do you go for something slightly more sophisticated first time than going zero then that?
It's a good question. I think if you have a vision, you have the financial model which backs it up, which has been tweaked, so sort of professionally reviewed, and that shows that you have a need for it in the future. You can definitely save money by putting the more expensive and complex system in place early on. The question is, do you have the money, and is it money well spent now? It depends on your hurdles. Are you looking to get to 2 to 3 years with the cash that you've got, and it's going to have a better return elsewhere? Most likely. So it's a very difficult question to answer, to be honest. But if you have the money available and it's going to add value from the analytics, for sure, you should put the more expensive system in place. But with that comes more expensive people, generally. Processes around it. So you have to have the expertise that can manage that system. Having a full ERP system for Microsoft Business Central and then not being able to follow the processes you've put in place, there's no point having it. You may as well have a basic zero system where everyone can follow, and the data it's simple, but it works.
That makes sense. Yeah, it makes a lot of sense. So if we then dip into structure and how, I guess how you've evolved your structure from being a standalone finance director, CFO, and what are the considerations? If you could just talk us through that, that'd be awesome.
Yes, so the first aspect, core finance structures, would include the accounting, control, and reporting function. So that's the foundation of any sort of finance team, finance function. That's the part you need to get right. So the focus should really be on a slick process, fast month-end close, and strong controls. And then for me, the next part would be focusing on financial planning and analysis. That's ensuring correct opportunities are taken, cash flow is managed. That's the next building block. And then on a very high level, we're looking at decision support after that. So basically bridging the gap between data and decisions, which is the value add part we talked about earlier. And part of that is, relationship and insight. It's being able to interpret those decisions or the data and make the recommendation to the board, and having the trust, doing it in such a way where, you're able to negotiate, able to get your point across appropriately so the right decision can be made. And then the business model and automation implementation, like I said, I think for me that's a priority, or was a priority, because I think if you're looking for the long term, you want to automate anything which can be automated, because it increases accuracy and it reduces costs. So once especially if you're scaling, then you're going from 100 invoices a month to 5,000 invoices a month. With automation, the cost increases per invoice, but much lower. So you don't need 10 people, you still need one person to manage what pops out of that automation effectively. And then we talked about it briefly, but it's hiring versus outsourcing. So I think for lower costs, you can lower your cost initially by outsourcing if you've got 50 to 100 invoices per month, for example, until you reach the need for a full-time employee. Outsourcing can provide valuable access to knowledge and expertise, obviously at a much lower cost. You're taking a day of somebody's time rather than having them on the books full-time effectively. And as the business scales, hire in the more value-added areas first, because they're the harder people to find, and they're the people that can translate business objectives into sort of finance strategy and give that decision support aspect. I think hiring a group of bookkeepers, it's going to mean your invoices are captured correctly if you don't have automation, but it's not necessarily going to add value that the business needs at that early stage.
When you're hiring a number two to you in a head of finance role, or you've got two number twos, one on controllership, one on heading up the FP&A or analytics function or BI, what do you look for, I guess, character-wise? Because it's obviously quite a scrappy environment. So what do you look for character-wise and skill set-wise? What's really important?
Yeah, obviously, you have the usual sort of base. The experience is very important. Again, it depends on where you are, what money you have to spend effectively, because that can drive what you're able to get. But for us, in the way our business is run, we look for people which can react quickly, make decisions, and effectively build. I think that's the difficulty. I've been involved in hiring a lot of the senior team. So, like you said, almost like a COO at Teqball at one stage. And the difficulty is when you're building something like Teqball, is finding people that can build something with a blank sheet of paper. And that doesn't matter if you're looking at somebody which has been a senior director at Nike, Adidas, some very, very big players. It's very different when you come in and you're given a blank sheet of paper. So any hire that I personally make, I look at the ability for the person to grow, adapt, and build, develop. That's very important for our group, especially.
Thank you for that, Jason. We just dip onto this one, which I think is really interesting, obviously, because you've got so much kind of exposure of the external advisors and who to choose and what's most important, and then the key milestones. So if you could give your insights on this, it'd be really interesting.
Yeah, sure. So, I think you have to be clear on what you want from an external advisor. So you have to be very specific as to what your objective of hiring that advisor is. I think you should be work with the advisor once you've identified one to come up with a scope and then milestones. I think milestones are very, very important to keep people on track so that you can ultimately hit your objectives as a business. And depending on if it's a firm or if it's an individual, definitely understanding their other client commitments is very important to see how you would fit in. Are you taking 1 day a week? Are you taking 1 day a month? How will that look in 12 months' time? You're investing in the advisor as well, remember. So you don't want somebody which can give you a day now, but can't give you 2 days in 6 months' time, because you've invested time in that advisor to help them understand your business model. So, and then what to look for an advisor? Character. Definitely, character is probably the number one thing that an advisor should have. What I mean by character is integrity. Does the advisor put the client interests above their own? You want somebody who's not afraid to challenge the business owners at the sort of risk of their own position. So you need that challenge for the business to move forward. You definitely need that challenge. You need somebody which has the experience, which is definitely relevant to the objective in question. The creative problem solver, because that's ultimately what you're paying for. If they have the experience in solving problems, that's definitely a key sort of skill set that they need. Strong communication skills, because that sort of starts with them listening to the business. I think if you're looking at an advisor which doesn't ask you questions, it's definitely the wrong advisor. because they can't give you anything other than generic advice without really understanding you, your vision, and where you want to take the business and the business model. So really strong communication skills, but that starts with listening. And then there's the interpersonal skills. So relationship of trust definitely needs to be built between the two, the client and the advisor. The right advisor will definitely create value. The wrong advisor will destroy value.
And in terms of the due diligence piece, there's so many factors to consider, because essentially the buck stops with the CFO on this element, and there's a lot of, I guess, pressure, and a deal can get so far, and I'm sure you've had this in the past where it's fallen over and it's only one person's fault. So yeah, just talk us through kind of the big ticket item.
I mean, I'd never say the DD is one person's fault as such, but I think you can definitely cover off the risks by being prepared. So, due diligence, if you're looking at investment, will often cover financial due diligence, legal due diligence, and commercial due diligence. So I'm just focusing on the financial side here. But I think the first part is understanding why they're doing due diligence in the first place. That's understanding the underlying earnings of the business to ensure that the business can continue to make those earnings, and understanding the true net cash or current debt position if you're at a later stage fundraise. Really ensuring that the investor or the buyer, if it's an acquisition, is fully aware of the financial position. So I think to be ready, you need to be able to review documents in light of what they're looking for, those two key points. Ensuring all documentation tells the story that you're expecting it to tell. And if it doesn't, then you can cover that off early and raise it to the other party at an earlier stage. It's much better raising it and saying this is why this says something different, than having them question you at the 11th hour. So I think being prepared for the data room, ensure documentation is clear, easy to follow. That includes naming of documents, referencing of documents, opening, having somebody go through the documents to make sure that the financial analysis isn't unfollowable. I always use a rule that's for my team: if anybody gets hit by a bus, I want somebody to be able to come in and pick it up as though they'd done it themselves. So one recommendation I would have is definitely clean up any management minutes. That's something they definitely look at. And if the expertise isn't in-house, as in the CFO is too close to it, you can bring somebody in to do a high-level sort of consultant review of the data in the data room. That can even go as far as vendor due diligence, which is normally saved for the larger deals, but that's a great sort of tool to sort of prepare you with answers with a ready-made vendor due diligence pack to give to the other party. But it can be expensive, so it's probably more for a Series B, Series C.
And an FD, maybe it's an up-and-coming FD and looking to step up to a CFO in a Series A, needs to do a Series B and kind of growth story before, ideally looking to realise an exit. What sort of advisors do they need to surround themselves with? And some of them, it could be a relationship that they're establishing but doesn't really utilise them immediately, I assume.
I think the relationship is always in the UK. The corporate finance teams, that some accountants have corporate finance teams with specific boutique corporate finance houses. That's my background. We always said that when you're looking at speaking to a business, you're really planning. You need to be speaking to them 5 years plus before to plan for the business exit, investment. Investment is a little bit different, but exit, 3 to 5 years, you should be building that relationship, building that trust, speaking to them, ensuring the business is positioned, ready. What do I mean by positioning is you can take any business. You may think that you're in healthcare, but healthcare may have a multiple of 8. If it has a tech element, maybe it's positioned as health tech, which has a much higher multiple. So it's very important to get the advisor's input early on, because that helps drive the whole positioning of the business, which can drive a huge amount of value.
Yeah, because I guess it's too late. If you were a healthcare business and you wanted that tech element to to get the 12 instead of the 8 multiplier, it's difficult to do that a year outside of the exit process. You need to be
definitely more challenging.
Testing the product, launching the product, getting customers. And I guess also from a founder perspective, if you're presented the argument, you can then decide which way to go. You don't necessarily need to go down that route for the higher multiplier, but at least you're aware.
Exactly. It's understanding the market and the wider market. What any good advisor will understand, where you sit in the wider market, how what other deals are being done, what sort of multiplier you're looking at, and what you need to do. Maybe you need to change an aspect of your management team. If you're looking for investment, one of the key drivers is the expertise of the management team. It doesn't really matter if you have the best idea in the world. If you don't have a strong management team, you're going to struggle to find finance.
What responsibility, obviously there's finance due diligence, there's legal due diligence, there's commercial due diligence, there's some of those, as you said, don't fall directly with you as the finance leader, but what sort of responsibility, nudging, probing do you have to do? Or obviously in an ideal world, the senior leadership team should be fully on board with what their responsibilities are, but how do you define that and get everyone on the same page?
It's a good question, and it really depends on the structure of the business. So if they don't have a legal sort of team, which many businesses don't, we do, then you need your external legal advisors to help produce the legal data room effectively. So commercial is sort of, it would probably be driven by the CEO and the COO and probably the CFO as well. So the commercial sits between a number. The finance aspect definitely just sits with the CFO.
And on the external advisors piece, you're talking around breaking down objectives to make sure there's defined milestones. Obviously, there's a cost element with things falling behind, so I guess that's one of the drivers. But what do you mean by that? What's so important about that?
Yeah, because I think everyone needs their own. You need to be able to derive what the advisor's responsibility is and what the company's responsibility is. So, I've worked on many deals in the past where I'm hitting my timeline, my objectives, but my objectives are sort of driven by what's provided to me by the client. So if the client gives me data which is in not a good shape, that's going to push me back, 3-5 days, so I can, rejig their financial model or input into the business plan. So it's really ensuring, each part is aware of what they have to provide, in what format, and when. Because any delay from either side is going to have an impact on the process.
That's really interesting. Well, look, thank you so much. I don't know if Laura's had any direct questions. I can see there's a couple in the chat box, but if there's any direct questions, then happy to kind of answer any. We've got 5 minutes or so, Laura.
Yeah, correct. So there is actually one question. It's about Xero, and the question was: is it better to choose the system that you will need in 5 years, or to plan to migrate from Xero later?
It's a good question. It's very difficult to answer without knowing the business model and where the business plans to be. If you have the cash to invest in a finance system for 5 years plus, I always would. I think it just takes time and effort, and it's a long and not an easy process to move finance systems, depending on the complexity. If it's a vanilla business, it's not difficult. If it's manufacturing, the inventory side, multinational, it can be a huge challenge, to be honest.
And then there was another question. How important are non-financial KPIs in fundraising process?
So we touched on it, or I think I mentioned it a minute ago, that you need a strong management team. So the management team and experience is very, very important in the fundraising process. So that's one aspect. I think more and more non-financial KPIs are becoming important. So, you have people are now focusing on sustainable and socially responsible investing. So therefore it's much more focused on environmental, social and corporate governance. So there's definitely a shift recently away from just pure financial KPIs. So yeah, it's a relatively recent thing, but there's definitely a move away from pure financial KPIs. But like I say, the management team experience is a key component of any fundraising process.
And then I don't know if anyone else has any other questions. Feel free to raise your hands as well. Oh, there's just one that came in. Just reading, sorry.
I'm terrible at looking at two things at once. Sorry, Laura. I mean, we'll also, obviously Laura's going to send around a kind of a recording of the session, and my details and Jason's will be on there. If there's any specific questions, we can obviously answer one-on-one. But if anyone has got anything now, then happy to answer.
Yeah, I think some people are mainly they're just asking to get in touch as well. So I think we'll finish it here. And if any other questions pop up, feel free to send Andrew or Jason an email. I'll follow up with their.
Yeah, perfect.
Thank you very much, everyone, for joining today's session. We really enjoyed it. I hope you too.
Yeah, thanks, Laura. Thanks, Jason, for your time.
Thank you all.
See you later. Take care.
Take care all. Bye-bye.